Most investors think the smartest thing you can do is to stay fully invested at all times. And honestly, that's not a bad idea. But here's what they never tell you. The investor who actually builds wealth aren't the ones who were fully invested. They're the ones who had money ready before the crash happened. Today, I want to show you the exact system I use to make sure that I'm always ready, including the specific rules I follow, the exact buy orders I placed during the last market correction, and the real portfolio numbers to back it up. Because this isn't theory, this is actually what I did. I'm Neil Richard. I spent my 40s investing the wrong way. Then I built a system that actually works for me. If you're building something serious, calm, patient, and no noise, I post every week and I'd love to have you along. Here's what we're covering today. First, why keeping some money out of the market is actually a smart long-term strategy. Second, the exact rules I follow for buying market dips. And third, what my actual portfolio looked like during the last market correction, including the real numbers. Because if you've ever watched a market drop happen and thought, I wish I had money ready for this, this video is for you. Let's get into it. Being fully invested feels smart when markets are rising, but it actually feels terrifying when markets are falling. And here's the problem. When markets fall and you have no cash ready, you have actually two options. Hold and watch your balance drop, or sell something to free up cash. Neither is an option you actually want. The option you want is to buy, because buying a diversified global equity fund at a 10 or 15% discount is actually one of the smartest moves a long-term investor can make. But you see, most investors can't make that move. They have nothing left to deploy. No dry powder, no waiting capital, nothing. And that's the problem this system solves. Here's what most investors never stop to calculate. Global stock markets drop 5% or more, roughly 3 times per year on average. 3 times a year. Which means a 15-year retirement runway, you will have approximately 45 separate opportunities to buy quality global equities at a meaningful discount. 45. Same market, same funds, completely different outcomes. The investors positioned to take advantage of even half of those are building something dramatically different than the investors who just watch. The difference isn't intelligence, it isn't research. It's whether you have a system ready when the opportunity arrives. And that system starts with one decision. I keep a deliberate portion of my portfolio in short-term US Treasury bills. Now, I know Treasury bills sound boring. And actually, they are boring. That's exactly the point. 1 to 3 month maturities, liquid within days, currently earning 4 to 5% while they wait. Which means my capital isn't sitting idle. It's earning income while waiting for the next opportunity. Now, my global equity fund, or whatever it is for you in your situation, that's where the wealth gets built. But the treasuries, those are my insurance policy that I actually want to use. Because when the market drops and you have reserves ready, you don't feel fear. You feel opportunity. Now, here's the critical part. Having reserves isn't enough. You need rules. You see, without rules, this becomes emotional in practice, and emotional investors make mistakes. So here are my actual rules with no expectations. Rule number 1, when new money arrives, I wait for roughly a 5% pullback. That's it, not 10, not 20, just a normal dip that happens multiple times a year. Rule number 2, if the market keeps rising and no 5% dip arrives within 3 months, I deploy 25% of my waiting capital anyway. This prevents permanent hesitation because missing a bull run has its own costs. Rule number 3, when a dip does arrive, I use a limit order ladder, multiple buy orders at different price points below the current market, placed before the dip happens. So when the market drops, the orders fill automatically. No panic, no screen watching, no emotional decisions. The system simply executes. Now, let me show you exactly what that looked like for me. Recently, the market dropped roughly 10%. What you're looking at on the screen is my actual global equity position. You can see the price dropping from around 178 down to approximately 162 in late March and early April. That's a 9 to 10% correction. And those dots on the chart, those are my actual tranche buys, limit orders placed in advance, not during the panic, before it. When the price hits those levels, the orders filled automatically. Now, I want to be honest. I did not catch the exact bottom. The lowest point was around 162. Some of my orders filled before that level. But here's what I've learned about chasing perfect timing. Preparation beats perfection every single time. What matters is that I bought significantly below where the market had actually been trading. And those units are now working for me in a recovering market. Okay, in the next picture, here's my portfolio balance. As you can see, I've increased my portfolio amount significantly. That's the system. Now, here's the part that most people ask about. Where does the money sit while waiting to be deployed? So I keep my waiting capital in short-term Treasury bills. 1 to 3 month maturities, liquid within days, backed by the US government, and currently earning somewhere between 4 and 5% annualized. I'm getting paid to wait for a better price. Patient capital, earning income while positioned for opportunity. So here's what I want you to take away from this. Most investors are taught to think about investing as a passive activity. Put money in, leave it alone, don't touch it. But there's a more active version of patience available to you. One where you're not just riding the market passively, but systematically taking advantage of the volatility that scares everyone else. Not through prediction, through preparation. A simple set of rules, capital held in reserve, orders placed in advance. That's what the last correction looked like from inside my portfolio. Here's the important part. The specific fund I used, the structure I chose, those details depend entirely on where you live and how you're taxed. If you're American, your structure is totally different than mine. If you're Canadian, different still. What it holds, why you chose it, and whether it matches where you actually live and how your portfolio is structured. Because those questions deserve its own honest answer. But the system I showed you today, Treasury bills, limit orders plus rules, that system works regardless of which specific fund you chose. If this video gave you something useful to think about, and you've watched this far, you're exactly the kind of person this channel is built for. I put together a free questionnaire called the Long View Retirement Checkup. A few simple questions that help you see if your real situation, savings rate, timeline, and what next steps you could take. Link is in the description. It takes about 5 minutes. See you in the next one.